All right. Welcome to today's webinar. Today is the 2026 update on the US exit tax, Section 877A of the Internal Revenue Code, and how it works. And as I was just saying a moment ago to some folks before the recording commenced, we'll actually be delving into Section 2801, which is a sleeper provision of the HART Act. Not a lot has been said about it over the past 17 years that this law has actually been in effect. So let's get into it. Please note that the advice provided here today, or the information provided here today is general in nature, does not take into account your individual objectives, financial situation, investment objectives, or needs. You should carefully consider the appropriateness of any information, strategy, or recommendation in light of your personal circumstances before acting on it. Of course, I do have a number of clients who are here on today's presentation, but for them, this is intended to be background educational information that we will review in light of their circumstances at the appropriate time. I should mention a YouTube channel. If the topics I'm talking about here are of interest to you, then you should know that I have a YouTube channel with many dozens, apparently 83 different videos up on everything to do with how to allocate capital between the US and Australia, how to bring retirement accounts over, Social Security, and one of the most popular topics actually has been the blog, the V blog. It's always a hard one to roll off the tongue, that one. Talking about the situation my family went through as we moved first from the US to Australia, then back from Australia to the US, and then again from the US back to Australia, where I now am. I should mention also the Social Security for Australians in 2026 is up, so feel free to go and check that out. Little bit about me here. Whoops, sorry. Little bit about me here. So I'm a tri-citizen of Australia, the US, and the UK. I was essentially raised here in Brisbane. I did my studies at the University of Queensland, moved to the US in 2005, worked in corporate finance for an investment bank also for a short period of time before going to an information session offered by UC Berkeley Extension to do with being a financial planner. And it was at that information session that I saw the light, the scales fell from my eyes, the angels sang, and I said, this is what I was called to do. And so I reoriented my career to be a financial advisor, which I have now been really since 2010 when I first entered the profession. I'm also the founder of the Global Financial Planning Institute. That's a membership organization for financial advisors. So I'm the guy that puts together the courses for other advisors on all of the things they need to be mindful of in working with clients whose financial lives cross borders. I'm also a frequent conference speaker. Recently, in January of this year, in Phoenix, Arizona, talking at the Advise On conference. Okay, kind of clients we work with. Here's three examples right here. So the Australian business owner living between the US and Australia, the high net worth Australian family currently living in the US, but looking to figure out their exit tax situation, how they might manage that. And the Australian executive and his family that permanently relocated to the US. So lots of different results obtained for those clients. I should mention the GFP Institute is a proud sponsor of today's webinar as well. And so if you know of someone who has a cross-border need not be Australia, it could be New Zealand, it could be Portugal, Spain, Italy, UK, whatever, then go check out the GFP Institute and click on Find an Advisor and find someone who actually knows something about cross-border work. When I got into this field, I found that there was no organizations, there was no education, there was no credentials, there was no nothing for international and cross-border clients. And so that was the genesis of the GFP Institute. All right, so that brings us to the outline for today's presentation. So we'll be going through talking about, of course, what the HART Act is, providing a little bit of a refresher on that. Covered expatriates, the consequence of being a covered expatriate. What does that term mean? What is an act of expatriation? What we're talking about, the word expatriate is used here, obviously, in covered expat, but what does it mean? How does one actually expatriate? Does that merely mean moving overseas, or is it doing something more involved? How is the exit tax calculated? We'll actually be only doing a brief review of that this time round. Instead, we'll be going deeper into Section 2801, as I've mentioned already, and then strategies to avoid or minimize the exit tax. Okay, so a refresher on the Heart Act. And here's an interesting here's an interesting image that AI generated. So it's showing it's intended to be a toll gate that's casting a very long shadow over the US. And it's an apt visual metaphor for what happens here. The US has an exit tax. If you meet one of three criteria, you will be hit with an assessment on your way out. So where did this acronym HEART Act come from? It comes from a 2008 act, the Heroes Earnings Assistance and Relief Tax Act. What's interesting about this is if you do your own web search on the HEART Act, half of the web pages are to do with the beneficiaries of the HEART Act, who happen to be the vets of foreign wars, and the proceeds that come from this exit tax are supposed to benefit these veterans with some support and services. So this came into effect in 2008 to provide, as I mentioned, provide pension benefits to U.S. military service members. So bring significant consequences for expats and possibly their heirs of a covered expat. So the HEART Act weaponized the tax code against departing citizens. Prior to '08, the expatriation triggered a temporary 10-year trailing tax. The HEART Act, as it exists today, is a two-pronged fiscal trap designed to capture global wealth accumulated under US jurisdiction. I think that I'm just going to take a brief aside here and mention something, and that is the US is not alone necessarily in having an exit tax. Australia has something similar. They're just smart enough to not call it an exit tax. In Australia, it's called taxable Australian property. So if you've been an Australian tax resident and you've got Australian stock or a closely held business or investment property, and you move overseas, the tax obligation on that property did not go away. Very few people know that you need to actually file a return upon your departure. And there is, in a similar way to how the HEART Act works, there is a deemed disposition rule that works upon those properties or those assets, the taxable Australian property I just alluded to. So many of my clients will discover years later when they're returning to Australia that stock that they were issued before they even left for the US is actually taxable at very, not entirely, but mostly at very unattractive non-resident rates. But that's a topic for another day. So the US isn't alone in having an exit tax, but it is alone in having citizenship-based taxation. And so being a US citizen or permanent resident, a long-term permanent resident, will get you caught in this exit tax. It will also mean that if you continue to be a permanent resident or citizen abroad, then there's a whole host of things that will go with that. And I've written white papers, done presentations on that topic many, many times. So please feel free to go check out the YouTube channel for more information on that. Back to this toll charge. So the two prongs would be 877A. That's the deemed disposition exit tax. So if you happen to be assessed as a covered expat, you've got to worry about the exit tax. And then your heirs may need to be, if they're US citizens and in your estate planning, you haven't taken this into consideration, you've got US tax resident heirs, they're going to receive gifts from a covered expat, then they're going to be hit at 40%. So who is affected by it? As I've alluded to, but here we are on the screen with the specific definition. So anyone after June 17th, 2008, who is either a US citizen by birth or parentage, and a long-term, note that little asterisk there, US permanent resident, i.e. a green card holder, are affected. Only long-term green card holders, however. So who is a long-term green card holder? if you have been in possession of a green card for 8 of the past 15 years, you are a long-term green card holder. So another way to phrase this would be anything more than 7 years, and it wouldn't matter if it was 1 minute of 1 year, the whole year counts. So if you got your green card on December 31st, then the entire first year counts as 1 year. So you then have 6 years henceforth before you would you would have to be out of the US or otherwise be considered a covered expatriate. Okay, so who is not included here? Who's not included would be temporary residents. So people on E3 visas, O1s, L1s, H1Bs, etc., etc. So here is the test. New graphics here to explain this. I think this is a much neater graphic. If you meet just one of these three objective tasks, you are a covered expat. So first test, which I would say ensnares most people, is the $2 million global net worth test. Now, I think it's very unfair. That is not indexed to inflation. What they have done is they, as you can see on the right-hand side in this second green box from the top, they have a mark-to-market, that's MTM, exclusion of $910,000 of capital gain assets. So that's great that there's an exemption, but what's not great is that as years go by, more and more people who expatriate are getting caught by this, what is becoming a relatively lower level of net worth. If you own a home in one of the major cities of the US and have a retirement account, you can very easily hit that $2 million threshold. Next test, the income test. Did you have an average net income tax liability over the 5 preceding years greater than $211,000? Now, let's be clear. That's not, did you have income of average income of $211,000? That's a tax liability. So you've got to be making a pretty decent income to have a federal tax liability of that much. And I should mention it's federal tax, not state combined. So you, as a married filing joint taxpayer, you're probably making north of $700,000, $800,000 to have an income tax liability of that much. What can skew that could be a year in which a major long-term incentive bonus gets paid out. Let's say you get paid $2 million in 1 year, which happens to be in that past 5 years, then that could skew your 5 year average and throw you up above that 211. The bottom one is the compliance test. We don't really work with, I shouldn't say really, like there's an exclusion. We don't work with people who aren't at least compliant or making efforts to be compliant, because clearly these are the laws, and that's one of our value adds is we're helping people be globally compliant with their tax and other compliance obligations. So you've got to be compliant with your state and federal taxes for the past 5 years. What are these numbers? Just reviewing this. So the income test 211, we just saw that. That is indexed annually. The mark-to-market exclusion of 910,000 on capital gain assets, that's also indexed annually. The lifetime exemption is now $15 million. That's a pretty significant number. So you can give away up to 15 million US dollars, you and your spouse, I should say, if assuming that they're a US citizen or permanent resident. I actually think I have to double check on the temporary resident to see how that would apply, because transfer taxes actually work on a different structure. They work based on your domicile, not your tax residency. So if you were a temporary resident, yet somehow there was something in your fact pattern that suggested that you intended to stay in the US forever, which is going to be a hard case to argue if you're on a temporary visa. But nevertheless, you may also be entitled to that lifetime exemption. But as I said a few slides earlier, it doesn't matter anyway because they're not subject to the exit tax. They may wish to make a gift, a significant gift for some other reason, however. Maybe they're intending on converting to a green card or to ultimately become a citizen. The bottom rectangle we have here is spousal limit. So this is gifting that a non-citizen may make to their, or excuse me, is it the other way around? The gosh, it's no, I'm pretty sure it's the non-citizen, the permanent resident may make a gift to their citizen spouse of 194 per year. So don't be confused by these gifting limits. You've got a lifetime gift of 15 million that definitely does apply to permanent resident holders to a citizen spouse, and then the annual limit of 194 from a non-citizen spouse to a citizen spouse. Okay, consequences of being a covered expatriate, as we shall see. So, Hart Act affects both the income and estate gift tax systems. Estate and gift, otherwise known as transfer tax. You're transferring wealth to someone else. So the coverall term there is transfer. So the present impact to the covered expatriate is the income tax on the exit, or you could say the exit tax on the exit. And that'll be discussed in detail later in this presentation. Essentially, your estate, your net worth is divided into 5 different tax asset classes, and each of these asset classes is taxed in a very particular way. There's also the future impact to a covered expat's heirs, which I'm going to talk about today. This is the Section 2801, making a covered bequest to a US beneficiary where that 40% inheritance tax applies. No, thank you. What is an act of expatriation? Okay, so this is important to define our terms. When a US citizen moves overseas, are they expatriating? Well, by one definition, yes, but for the importance of the Hart Act, no, they're not. A US citizen who relinquishes their citizenship, which is certainly something you would not be able to do this by accident. I mean, this is a very conscious and intentional decision, and must be done once one has secured citizenship or I would say permanent residency at a minimum in another country. Typically occurs via renunciation before a diplomatic or consular official. Or you cease to be a US lawful permanent resident, which is done by submitting this Form I-407, which we see a screenshot of here at the bottom of the slide. So the funny thing about this is that people who have had a green card for many, many years and have let it lapse, they may not be aware that their legal entitlement to permanent residence to live in the US has gone away. It's no longer valid. However, there is a distinction between your legal residence and your tax residence. That tax residence does not go away until this form is filed, but you need to be very careful before filing this form because, and this is happening unfortunately in the current administration, people are getting caught at the border. If they've been out of the country for more than a year or certainly 2, then they might, it's going to depend on that particular agent that they're dealing with, but they might be forced to sign an I-407 at the border. And if you sign an I-407, that is an act of expatriation. And so you may be subject to an exit tax there. I've had long ongoing relations with a tax attorney who's told me about such things, and indeed well-informed clients of the tax attorney I'm thinking of have actually had to turn around and get straight back on the plane for fear of triggering an exit tax. So that's how serious this is. And it's possible for an unintentional administrative act of expatriation to occur. That's what I was just mentioning there, to do with what can happen coming through immigration. Now, how is the exit tax calculated? As I've mentioned a few times now, I'm not going to go into detail on this in today's webinar. That's something I did a year ago where I went through all 5 of the different tax asset classes in detail. But I'm going to go through it at a higher level here. So what happens is the day before your expatriation, the IRS will take a look at the global net worth that you have, and joint assets are mostly going to be treated as 50-50 unless you've got some very clear accounting to suggest that some other percentage allocation should apply. but they're going to look at your total net worth and say, do you exceed this $2 million? Did you have an average federal tax liability in excess of 211,000? And are you compliant with your state and federal tax obligations for the past 5 years? So if you meet one of those tests, you're subject to the exit tax. What does that mean? That means they look at everything and then divide it up into these five different categories. Never mind this table that you see here. This is really just intended to be a graphic to get attention. But in this example, this hypothetical example, it's saying that someone had a $10 million unrealized gain. Therefore, they're going to get hit with a capital gains tax in this instance on the $10 million. They would get, to their credit, however, they would get a $910,000 exemption. So the total amount that would be subject to capital gains tax would actually be 900 and what would that be? 900,000. 10 million minus 910,000. I guess that's 900 sorry, I'm underslept today. I can't talk and do that math at the current. $9,090,000. There you go. Let's keep going here. So the mark-to-market sieve. So not all gains are taxed immediately. The code provides a buffer, but any appreciation exceeding the threshold falls directly into US capital gains tiers. So in the example I was just giving a moment ago with this $10 million gain minus 910,000, so that's $9,090,000 that would be subject to capital gains tax at 15 and 20% rates. It would mostly be subject to 20% rates. And then possibly plus another 3.8% net investment income tax. Okay, here are those five categories you've heard me refer to. So there's specified tax deferred accounts. That's going to be your IRAs, your HSAs, your rollover IRAs, your Roth IRAs, etc. Eligible deferred compensation. Those are your 401ks, your 403bs, and qualifying 457 deferred compensation accounts. Ineligible deferred compensation, that would be, tends to be stock options, 83B plans. There's a category, there's a number of others in this category, but it's pretty rare, I will say. I've not seen it. I've got few clients that would trigger ineligible deferred compensation. Beneficial interests in non-grantor trusts. Very important to understand that, because one of the strategies for managing the exit tax is to do with what's called an expatriation trust, which is precisely where you are creating a trust of which you are a beneficiary, and you need to make it such that it's clear you don't have excessive drawing rights on that, because otherwise it would be pointless. It would come right back into your estate. Mark-to-market assets. I think a more descriptive term for that is capital gain assets. So I commonly see this with clients who've got highly appreciated securities. They've got significant capital gains, perhaps on that, or a house, or an investment property, or a closely held business. That's where you get the capital gains treatment. So let's just run through how the exit tax works on each. Specified tax deferred account. This is the IRA. So say someone's got $1 million in their IRA, they expatriate, they're a covered expat. Bang, the entire $1 million is treated as taxable income on the day before that expatriation. So that could result in a significant tax pain. So typically the advice there is to spread that out, or the distribution of such an account over many years, or possibly roll an IRA back into an eligible deferred compensation account. So an eligible deferred compensation account most commonly is going to be a 401k. The way that's treated is interesting. So it's essentially, as the name would suggest, it's deferred. And the reason for that is because the asset is held within the trust, a separate trust structure. It's not technically someone's free and clear property if it's in a company 401k. Someone may be the beneficial, or I should say the ultimate beneficiary of that account, but presently it's held under a separate trust. So the way that works is there's essentially an earmark that's made by the IRS on that account for 30%. So they say, we don't care whatever the treaty says, we're going to tax that account at 30% whenever it is that you distribute that account. Ineligible deferred comp, that's going to be taxed in a very particular way. Depends on the type of asset that it is, but mostly we're going to see ordinary income here. Beneficial interest in non-grantor trusts is going to depend on the type of income and the type of assets in that trust. Mark to market, we're looking at capital gains tax. Okay. One thing that some of you may have realized when talking about these different kinds of accounts, especially the IRAs, is that there's a liquidity trap here. And that is, if you get taxed on the balance of an IRA, you're not necessarily wanting to distribute that at the current time. Furthermore, you may not be able to distribute it without significant taxes from the foreign country due to the way that foreign governments tax retirement plans from other countries. Rarely are they deemed as qualified retirement accounts. So, for instance, Australia does not view a 401k as a qualifying superannuation account, and the US returns the favor. So, superannuation is not deemed to be a qualified retirement asset on the US side. So, both of them tax it in their own way. The way Australia would tax a 401k is they treat it as a foreign trust. The foreign trust is taxed according to how much is corpus, how much do the employee and employer contribute to that account, and how much is growth. And so in the example of an exit tax hitting an IRA, it may be that the penalty tax does not apply on the US side because it's an exit tax and they understand you're leaving. So the early distribution penalties don't apply, but it could mean that you get slapped by the ATO. So very, very poor treatment that could result in that. And then, as I mentioned earlier, eligible deferred compensation accounts, there's going to be an earmark of 30% on those accounts that will be withheld. Okay, this is the new content that I wanted to introduce in this year's presentation on the exit tax, and that's section 2801. So after lying dormant for 17 years, the IRS in January of last year released Form 708 to actively track and tax these transfers. So there may have been transfers that have occurred prior to that time, but I'm guessing because there's something about 18 years and someone becoming turning the age of majority that this would make this suddenly relevant. Well, it is relevant now, and this is the form that deals with that. So if a gift is made from a covered expat, I'm saying the same thing here, but if a gift is made from a covered expat to the heir of a covered expat, a US tax resident, a 40% inheritance tax will apply to that. It casts a long shadow. That's the purpose of this graphic that you see here. So the most draconian effect of the Hart Act is not the exit tax necessarily paid upon leaving, because with good planning, it's not always, if it applies at all, it's not necessarily even that high. It's if someone has children and they're thinking that gifts are going to be made to those kids, then that can really complicate the picture. Oftentimes, I'll see with expatriating clients who are doing this kind of planning with us that they may not care about being called a covered expat. It's actually only the amount of the exit tax that matters. And if that exit tax can be brought down with careful planning into tens of thousands of dollars, then at that point, it kind of becomes close to immaterial. Strategies to avoid or minimize the exit tax. So, first strategy here is take your capital gains exemptions and step up your basis strategically. The idea here is there are certain capital gain assets that are entitled by their nature to a step up in basis, that being the primary residence on the US side. So single filers enjoy a $250,000 step up or discount, I should say. Married filing joint, $500,000. So if one was to exit and the home was part of the assets pushing your net worth above that limit, and you're going to exceed the $910,000 exemption, then why not allow for an additional $500,000 of exemption to be made, and thus sell your home before you leave to capture um, that additional exemption. Tax loss harvesting. This is this is really something that needs to be done on an annual basis. So it will have limited benefit in this context, but it could apply and be very valuable depending on someone's circumstance. I'm thinking of if someone had a sabbatical or had a year of very low income, then what they could do is step up their basis. If they have an AGI, adjusted gross income, of less than about $98,000, then you're actually in a 0% capital gains bracket. So there's a possibility to step up your brackets. You can also take a $3,000 short or long-term deduction against ordinary income. Uh, sorry, a short or long-term loss against ordinary income over time. So that's another important tax deduction available to you. So the net effect of all of this, will it reduce the amount of the capital gain exemption you would need to use. It's still going to the even if you were to apply these steps here, the assets will still count towards that $2 million test. It's just that you won't have to pay capital gains tax a second time on them. So what are we seeing here? Individuals may progressively realize capital gains on assets over a number of years to avoid spiking one's CGT rate. That's another strategy. I would say this is one that doesn't get hearts racing quite as much due to the savings. But if you looked like you were on a trajectory to be above the 15% CGT rate, so you're going to go above 583,750 into the 20% rate, then clearly it would be beneficial to do that progressively and keep that CGT rate below 15%. And to be honest, 15% for a CGT rate when compared to Australia, where the highest rate is 22.5 plus 2% Medicare levy, is pretty good. So if you're going to have to pay a tax, 15% is not too bad. Okay, progressive gifting. I would say this is a strategy we use a lot more often. Progressive gifting to a non-expatriating spouse obviously only works if you have a non-expatriating spouse. Thankfully, many of the benefits of cross-border planning can be experienced if one of the partners has or is expatriating. So you don't need necessarily both to expatriate, or if you do, then they need not do it together. They could stagger the exit and do it a number of years apart. So unlimited marital gifting doesn't apply for gifts made for. I said this wrong earlier. I said it from a legal permanent resident to a U.S. citizen. Turns out it's the other way around. Made from a U.S. citizen spouse to a non-U.S. citizen spouse, regardless of whether it is a resident alien or non-resident alien. Resident alien means living in the U.S. Non-resident alien means not living in the U.S. and not a permanent resident either. The annual gift exclusion limits made is 184,000 in 2026, up from 190,000 last year. Gifts, and this is what people often forget. I would say people that have been talking to their accountants seem to get hung up on the annual gift limit. Not all accountants, please don't get me wrong, but most accountants tend to think in years. They in a single year. They don't think in multiple years or decades or do long-term planning. I mean, that's kind of inherent in the very definition of the word accountant. You only account for what has already happened, of course. So using your lifetime gift exemption, very few people are going to hit this $15 million amount, and it's indexed annually. So last year it was 13.99 million. It's going up by $1 million a year at the current rate. So do you think you're going to have an estate greater than 15 million? Probably not. And if you don't be afraid to use your lifetime gift exemption to get that out of your estate and even better, avoid the exit tax. So if the non-resident alien, there's that charming term again, spouse elected to be a resident of the US for income tax purposes in the year of transfer under 6013G and have done a webinar on Internal Revenue Code section 6013G before, they may be able to use this strategy. Other tax consequences should be considered. So this is where you really need to be talking to your accountant and your cross-border advisor to be clear on that strategy. Okay, an example here is Bob, a US citizen, is married to Linda, an Australian citizen. Bob is planning to expatriate from the US to Australia in 8 years' time. Bob's current net worth is 2.75 million, while Linda's is 300,000. So seeing as Linda doesn't seem to have any US legal status, this would mean that Bob could do annual gifting. Or if Bob didn't want to do that, it was later in the game and instead of wanting to expatriate in 8 years, it was in 1 year, he could just gift $1 million or some amount more than that and get under that limit and likely be okay. By making annual gifts to Linda up to the annual exclusion amount, Bob can gradually lower his net worth by the time he/they expatriate and avoid being deemed a covered expat. So what a wonderful outcome for Bob in this example. Another thing I was going to mention is something that came up very recently, and I really hope you're listening closely to what I'm about to say. So a client that I've been working with for a number of years on this topic expatriated earlier this year. So she's out of the US. She got her certificate of loss of nationality, which is essentially the gold standard that she's out of the US entirely. But what happened? This was early January. What do we know that happened between mid-January and late January? And that is we saw a rapid appreciation of the US dollar of about 3 to 4 cents in a very short period of time. That had the effect of increasing the value of her assets because she had, I'm not sure what percentage, let's say it was 30, 40% of her assets were held in Australia. Suddenly, the value of those assets spiked significantly and brought her to closer to that $2 million threshold. So for all this planning we've been doing for years, thankfully, we were smart enough to leave enough of a buffer. I've seen that happen before where clients just gotten a hair under the $2 million amount. Thankfully, there was no major currency appreciation that happened for them. But in this case, we left about $150,000 leeway. So she got down to 1.85 million. And the movement of that currency resulted in, I think it was like a $60,000, $70,000 appreciation of the Australian side of her balance sheet. So we all wiped our brow when we looked at what the effect of that was because there was enough of a margin that she didn't inadvertently trip the $2 million threshold. This was another strategy that I was alluding to earlier, the expatriation trust. More a strategy for higher net worth folks, given the advice fees and the annual compliance fees that you got to pay to trust companies to keep these things going and do their tax returns and the whole kit and caboodle. But the idea is that you set up a trust for the benefit of you, your spouse, and your children or other heirs. Doesn't need to be children. Could be whoever it is that you want to include in there. It just can't be exclusively you because that would be a see-through trust and that would not have that arm's length effect that a properly structured expatriation trust would have. So usually they're an irrevocable, discretionary, non-grantor domestic trust established and funded before the expatriation date, and it can benefit a number of individuals. Otherwise, it would be collapsed, as I was just talking about. The goal then is to complete a taxable gift using your $15 million unified credit into that irrevocable trust. You then expatriate some number of years later so that when you sign your Form 8854, you say, my financial circumstances haven't changed in a material manner in the last 5 years, which would be true. And then post-expatriation, you may now, with the discretion of a trustee, be able to enjoy the benefits of the assets in that trust and avoid having to be considered a covered expat. So it's very effective in its goal of avoiding that for high net worth folks. So, assuming a high net worth US citizen family where only one partner seeks to expatriate, you would establish an expatriation trust funded 6 years before the move, with members of the family, including the expatriating individual, being made members of this trust. The full $15 million unified lifetime gift credit could then be made to the trust. And remember, this is where the tax attorneys earn their fees, is applying certain discounts. So they could say, well, we need a valuation discount because there's illiquidity or there's a minority shareholder situation going on. They can get very creative, and so they can bring assets that at their market value might be worth well in excess of 15 million. They can get it to essentially shoehorn into that $15 million amount through legitimate tax strategies that the tax attorneys know of. So that would be an example of someone using this to then live off those proceeds, get out of the US, and not be considered a covered expat. Strategy 4, roll ineligible deferred compensation items into specified tax deferred accounts. So what would this look like? This is maybe not as sexy as the other strategies mentioned a moment ago, but the idea is you would take an IRA that would otherwise be subject to the ordinary progressive tax scale, roll it into a 401k where it's only going to be subject to a 30% tax at a future date. So in the example that I have here with Jennifer, she's a covered expat. She knows she's going to be a covered expat. She's moving to Italy, not Australia. There's a lot of movement happening right now to Portugal, Spain, Italy, and Greece, I should mention, quite aside from Australia. She's got an IRA of 500,000 and she's still working. She's got 300 grand in her employer's 401k. The 401k allows rollovers or roll-ins, as they're called. And so she could do that knowing that later on down the line, she's going to be in a lower tax bracket. And so there's a 10% savings that she would enjoy by doing that. So that's where that strategy comes into it. That's what I have for you today. I think I must have left people spellbound, thunderstruck, and otherwise speechless because unlike a regular webinar, there's typically a steady flow of questions. And I'll make an opportunity for that in just a moment, but I did want to mention another crowd favorite is this topic, which I'll be doing next month, shortly before heading off to Calgary and Denver. I'll be visiting one of the top tax expatriates in the world, if not the top one in the world, Moody's in Calgary while I'm there, and then seeing my staff in Denver when I'm in Denver. But anyway, before that, I'll be running this particular webinar, so you're certainly welcome to attend there. So the questions are rolling in. Okay, Mary Alice Rosa, if you retain your citizenship and do not renounce, are your heirs still? No, they're not. They're not because you never expatriated. You're not a covered expat because you never expatriated. However, Mary Alice, you might do well to look at the estate planning webinar series that I did late last year in Q3 and Q4 that deals with exactly that situation, because you may have, I don't know anything about you and obviously would not be giving you personal advice, but general considerations would be, where are your assets located? You may have assets located in a US state or have heirs in a US state that has an inheritance tax or an estate tax. Estate taxes, as the name suggests, they apply to the estate. Inheritance taxes apply to the beneficiary of the estate. So that matters because if you've got one estate and many beneficiaries, an inheritance tax might not apply. But if it was, say, a single child receiving all of an estate, then they might get hit with the double whammy of an estate and an inheritance tax. So long-winded answer to your question, but you'd need to be concerned with US estate taxes at the federal level, which would only apply with an estate in excess of $15 million, as I've mentioned here today, and then possibly state-level estate taxes that apply on the US side. Australia is very happy to receive additional funds coming into the country, so you're not going to be hit with or your heirs, assuming they're in Australia, would not be hit with any taxes that I'm aware of if they were to inherit assets here. Any other questions, concerns, or doubtful points? Yes, there is. Someone's written in the Q&A. Brett Batty. Hi, Brett. If you renounce U.S. citizenship, do you still have to file the U.S. federal return every year if you're getting Social Security? Great question, Brett. That's thank you for that. So no is the short answer. And the reason why is because for Social Security beneficiaries, the non-resident alien Social Security beneficiaries, which is what you'd be if you renounce your U.S. citizenship, they will tax 85% at 30%, which ends up being 28.5%. So they'll just withhold 28.5% from your Social Security. That way, the US government doesn't miss out, and you don't need to worry about filing that tax return. Okay, got it. Thank you. Is it usually advantageous to retain your citizenship if you are considered, if you would, I would word that differently, Mary asks, if you would be considered a covered expat. I don't think there is a clear answer to this one. I would encourage you to read material that I've written on this topic about all the obligations that go with being a US tax resident abroad, such as Brett was just alluding to, the need to file annual tax returns. You've got a non-aligned tax year, so Australia finishes June 30th, the US follows the calendar year. You've got state tax issues, you've got PFIC, so passive foreign investment company restrictions. I think the worst, the particular issue that impacts the most people is the retirement situation, and that is a U.S. citizen can't effectively participate in superannuation because it gets treated as a foreign grantor trust, so it becomes a taxable account to them. Similarly, an Australian resident with a US retirement account, they actually there's potentially much better treatment, but not necessarily for people that have held their US retirement account for a number of years, where a growth comprises a large percentage or majority of that account. The Australian tax can be pretty nasty in that case too. That seems to be all the questions that are coming in. Thank you so much for joining me here today. And I just have one small ask, and that is if you found today's material to be relevant, or you know someone who might be in a situation where they could benefit from advice from a cross-border professional, then please don't keep us a secret and mention Arete Wealth Strategist. Thank you very much and have a wonderful rest of your day.